Hi. Hi, good evening, everyone. I'm Linda Yu. I'm an economist at Oxford University and London Business School, and it's my pleasure to be the timekeeper today. But first, let me just thank David for some lovely organization and to thank all of you for joining us on Train Strike Day. So you must be really serious about economics. Very, very impressive. And in fact, let me firstly also thank you for your support of the Economic Research Council. I think this event that they do is a great way of getting involved, especially with the students in the room into doing some forecasting. So before I introduce the running order and what we're going to be doing in the next hour and a quarter or so, let me first tell you that the next event for the ERC is going to be Ha-Joon Chan of Cambridge University. He's going to join us to discuss the themes of his new book called Edible Economics, delivering his core economic arguments in the context of culinary anecdotes. That actually just sounds like a delicious book. So what we're going to do firstly is to give the award to the last year's winner, the forecaster that did the best. And then we're going to hear from our three titans as they give their forecast. And then there'll be about 10-15 minutes of questions from the audience that you could pose to them. So let me first give you the standing of the titans from last year's competition. So in third place, I just discovered is me. So I think I'm actually going to be leaving now. No, I'm very happy to be there. And you are too. You're a very, very nice crowd. I was about to say, I expect a bottle of wine or something, because you know when you run a 10K, they give the person who comes last a bottle of wine. Since I'm so close to the end, normally I just kind of hang back. That's why I'm last, is actually to get that bottle of wine. So I'm expecting my bottle of wine. Second place was Douglas McWilliams. He unfortunately can't be here with us this evening. And Dilip Shah won first place. Now, many of you who have watched this competition over the years knows that Dilip always wins, often wins. So he has a secret. We just don't know what it is so far. It reminds me of that football joke. You know, football is 22 guys chasing a ball around the field for 90 minutes, and then Germany wins. That's what it feels like when you go up against Dilip. But this is really exciting because the overall winner, and remember last year was really, really a challenging year because, you know, J.K. Galbraith has this joke that economic forecasting exists to make astrology look respectable. And this past year, you know, you had what was happening with COVID, supply chain issues. Who knew that a ship would get stuck in the Suez Canal? And then, you know, 8% of the world's ships are all in the wrong places. Yeah, and then Russia invades Ukraine. So it was a really tough year. And yet, despite all of that, the winner of the overall competition for this forecasting contest is a sixth form student. So not only did the student beat the general public, but it was also beat the titans, including Dilip Shah. So can you join me in inviting up to the stage and congratulating Ariana Daly? Congratulations. Here's a token that we hope you'll put to good use, but really is very, very impressive. And I'm also really pleased to say that Douglas McWilliams has offered her a role shadowing at his think tank, the Center for Economic and Business Research. So he clearly has spotted talent and jumped on it. So again, congratulations. Congratulations. Yeah, she's definitely one to watch. So this year, you know, you never say never, right? I was about to say, so after last year, surely this year will be a bit more predictable. Clearly, I'm tempting fate. So let's hear from the three titans. I'm going to introduce them each in turn. I'm going to introduce them in the order in which they'll be speaking. They will come up each and give their take on what's going to happen in this year, which of course, as all of you know, the economy looks like it's largely shrinking. Inflation is double digits. We still have the ongoing Russia-Ukraine war. There's just so many economic headwinds. So it should be an absolutely fascinating set of takes that you'll be hearing from these top economists. So let me introduce them in turn. Stephen Millard. He's Stephen, why don't you wave? Since Deputy Director for Macroeconomics, Modeling and Forecasting at the National Institute for Economic and Social Research. He's held a number of policy analyst and research positions at the Bank of England, stretching over 26 years. He's visiting professor at Durham University Business School. He's been doing that for over a decade, and at Portsmouth University since 2021. And then Yale, bit easier because you're the woman on the panel, Yale Selfin. She's chief economist at KPMG in the UK. Prior to this, she worked at 2 different economic consultancies, as well as at PwC for over 14 years. I should say Yale normally stands here, so clearly she and I have swapped just so she can properly give her take, which would be great to hear. And then finally, the person the last person, I should have thought of a more elegant way of saying that. So the person left is Ines McPhee. He's Chief Global Economist and Managing Director of Macroeconomics and Investor Services at Oxford Economics. He's formerly held a number of economist roles at institutions such as the Department of Health, HM Treasury, and Lloyd's Banking Group. So I'm going to invite up Stephen, and I'm going to be quite firm on time because I know that we don't want to run over, especially on such an evening. So I guess when you're out of time, I'll just whack you with the, with the paper.
Okay, I'm hoping to be very good here and actually finish well ahead of time. We'll see. The great Yogi Berra, one of my absolute heroes, said, prediction is really hard, particularly when it's about the future. So in that sense, I expect to come last in this competition, but I know that I'll be in very good company, seeing as Linda came last year. Okay, so what I'm going to show you is actually the National Institute's forecast. It's not really mine. It's the result of a team of people. They're all listed there. And I guess the point I want to make with that is I could do a forecast, you could do a forecast, somebody else could do a forecast, but actually putting those 3 forecasts together, putting those 3 heads together is likely to give you a better forecast. So teamwork is important. The other thing is, of course, if I do come last, I just blame all the rest of the team for it. Okay, this is what I'm going to do. I'm going to do everything in order, surprisingly enough. Output, then inflation, monetary policy, then the labor market, then exchange rate. And I'm going to somewhat cheat in that I'm going for 2 black swan events, which, well, anyway, we'll get there. Okay, so to start with GDP. Well, we had some GDP figures yesterday. GDP fell in Q3 of this year, as we know. Everybody is telling us we're in a recession, and in a sense we are. The sense is that actually my forecast is that we are not going to have negative GDP growth this quarter. GDP is not going to fall this quarter. I think I'm out on the limb in saying that. I hope so, because if I'm proved right, it's points in the competition. We're actually expecting GDP to be flat this quarter and then to fall by about 0.3% in the first quarter of next year. So over 3 quarters, we've got a fall of about 0.5% in GDP. And that's it. We are completely bucking the trend because we actually think GDP is going to recover in the second quarter of next year. And we got growth of 0.2% in both the second quarter and the third quarter. Why is that? Why are we optimistic? Well, I think we took a look at the autumn statement and we thought, actually, the autumn statement is being supportive of the economy. And when you really think about it, is there actually that much wrong with the economy at the moment? I mean, we got high inflation, we got a cost of living crisis. There are clearly a very large number of households who are really struggling, and that is an issue, and that is something the government should be doing about. But, you know, our businesses, are they struggling? Are they really struggling? No, we're pretty optimistic. So I'm hoping that I'm out on the limb, and my competitors will give you a much more pessimistic view of GDP. I also hope, of course, that we're right, not just because I want to win the competition, but because I just want the UK to be in a better shape next year than it has been this year. As GDP. So this is, we move on to inflation. This is the first forecast I'm going to get wrong, and we're going to know I'm wrong tomorrow because the inflation number comes out. And then I'm going to be on BBC Radio Scotland at lunchtime, telling them exactly why I knew inflation was going to be whatever number it is. It turns out to be tomorrow. So we have a peak in inflation, quarterly inflation of 10.8% in the fourth quarter of this year. So the quarter we're in, inflation is at its peak. It's going to come down all through next year. If you look at the monthly figures, that doesn't quite look right, because we actually think the peak of inflation will be in January, and it'll be at 11.1%. But this, over the quarter as a whole, inflation is then going to start coming down. We have 10.6 in Q1 of next year, 9.1, 8.4 in Q3 of next year. If I was in the Bank of England, I was there for a very long time, I would actually be quite worried though, because inflation is coming down. It's not coming down very fast. And as a result of that, the Bank of England does actually need to do something. It's got to keep increasing interest rates. It's no good saying inflation is going to fall dramatically down to target, so we don't have to do anything. Inflation is coming down very slowly. Bank of England has to continue raising interest rates. This is the second forecast I'm going to get wrong this week. On Thursday, I think the MPC are going to raise interest rates to 3.5%. If they raise to 3.25, I'm already in trouble. But anyway, 3.5, we predict on Thursday. That will give you a Q4 average of 3.2. And then we're expecting further rises up to a peak of 4.75 in May. So that's quite a fast rise in interest rates. But given the inflation chart, I just showed you that one, the Bank of England needs to do that. So there are my forecasts: 4.1, 4.6, 4.75 in the quarters next year. I have no idea when I started, so I have no idea how much time I've got left, but I'm not going to use it up. Okay, so talked about inflation, talked about monetary policy. The next thing that we've been asked to predict in this competition is the unemployment rate. So here I was very lucky because we actually had some data this morning. The unemployment rate rose. It's now 3.7%. And I was thinking that's good in the sense, or it's not good, but it's good in the sense that we are forecasting 3.8% for the fourth quarter of this year. Little bit of a rise in unemployment. And that's going to continue, we reckon, 3.9 in Q1, 4.4 in Q2, 4.4 in Q3. Why is that? Well, the economy has slowed down already and is going to continue to fall. GDP falls, unemployment rises. But it's not going to rise that much. And again, that reflects the fact that we're pretty optimistic. You know, we don't think the fundamentals of the UK economy are bad. And in particular, the labour market certainly isn't. So I had the very, very good fortune to study economics with a wonderful man who's since passed away, called Dale Mortensen. And Dale was one of a group of 3 people awarded the Nobel Prize in economics for really one of the classic Nobel Prizes, was awarded for saying something that is really simple. And that is that if there's a job over there, I can't magically suddenly appear in that job. I need to find the job over there, and the job over there needs to find me. It's like, duh, motherhood and apple pie, as they say. But this idea that matching jobs looking for workers, workers looking for jobs is a key feature of the labor market. That was something that really had not developed until pretty much Dale's paper in the early 1970s. And the whole way we think about unemployment now in macroeconomic models is exactly that idea that there are frictions that mean that it takes time for jobs and workers to match, et cetera, et cetera. What is the point of all of that? Well, what that theory suggests is that if you want to know how tight the labor market is, then all you have to do is you look at the vacancy to unemployment ratio. Number of jobs out there looking for workers, number of workers over there looking for jobs, and the ratio of the two tells you how tight the labor market is. And that picture is labor market tightness as measured by the vacancy to unemployment ratio. And what is amazing, well, there are two things that are very obvious about that picture. Now, is this going to work? It is. The first one is that, you know, it was bubbling along here and it has risen quite dramatically, particularly since 2012. There it goes, up, 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 up. Okay, the labor market has just gotten tighter and tighter and tighter and tighter. There are all these jobs out there and relatively fewer workers looking for them. And then the other thing that I find absolutely amazing, I can't really do this because I can't do a straight line, is that right here, it's right around 1. There is 1 vacant job out there for every unemployed worker. If I could work the magic and I could just drop workers into jobs, there'd be no unemployment at all. That's never happened. It's quite literally never happened until this year. There you go. That tells me that the UK labour market is really hot at the minute. It is really tight, which is another reason for giving me optimism about the UK. But of course, one thing about a tight labour market is it does encourage high nominal wage growth. And we kind of saw that this morning in the data, because wage growth reached a rate of 6.1% the year from the 3 months to October this year versus the 3 months to October last year. 6.1%. That's quite high, particularly in the recent context. Here we go. We think it's going to go a little bit higher, 6.4. But then as unemployment starts rising, we think wages are going to start falling. So this, we think, really driven by that vacancy to unemployment ratio, that rise there. But we do think there's going to be a bit of a fall next year. So 6.1 in Q1, 5.8 in Q2, 5.7 in Q3. Okay, I quite literally have no idea how much time I've got left, so I'm just going to keep going.
I'm working on it.
Oh, you're working on it. Okay.
You've got 3 minutes.
3 minutes, okay, ample time. So we were asked to, now, this is my favorite. We were asked to forecast the exchange rate. Well, we're not actually. We're asked to say what the low point will be in the sterling euro exchange rate over the coming year. Now, I'm glad we were asked that and not to forecast the exchange rate, because if there is one thing you should never forecast, it is the exchange rate. Completely unforecastable. I have a couple of colleagues here who will probably tell me I'm wrong there, actually, and that it can be done. Well, of course, we do have to have a crack at it. So we think it's going to gently depreciate to around about €1.15 by the third quarter of next year. But of course, the exchange rate goes up and down and up and down and up and down. Unfortunately, this is the quarterly series. It looks quite smooth, but it did actually come down to around about here, that point exactly when the laser is. Okay, it was the mini budget that did that, but exchange rates do move. So anyway, so I'm giving myself that amount of leeway. I think the exchange rate could hit a low of €1.12 over the coming year. We'll see what happens. Finally, we were asked to come up with a black swan event. Now, the whole point about black swan events is you can't come up with them. So this time last year, nobody would have predicted Russia invading Ukraine. So I thought, well, okay, what is very unlikely to happen, but could happen. And then I just thought, well, the war in Ukraine, well, one or other of two very unlikely things could happen. Unlikely thing one is everything could go really bad. It almost did, actually. I was about to give an interview with a radio station, and then a missile landed in Poland. So they said, strangely enough, that they didn't want to talk to me anymore. I wasn't interesting enough. But that missile landing in Poland could well have actually made the war sort of suddenly become pan-European, and all bets would have been off. Worldwide recession, worldwide inflation, civil unrest. The other alternative is it could suddenly stop, which would be great. I've been told to stop, so I'll leave you with my forecasts. Thank you very much.
Okay, right. So I've got loads of slides for you. So I'm going to be very quick and take you through, if you like, a story, and then hopefully you will be able to conclude. This is funny. To conclude from that, what to do. So let's see if this works. Brilliant. Okay. So we're going to start to look at prices first. And as you can see here in this chart that I have for you, that at least some prices are now falling. And especially when we look at metals and food prices, as well as energy to some degree, especially oil prices are falling. It's partially because we have better smoother supply chain, but also because global demand is weaker, and therefore prices are going down. Although fertilizers are still, the cost of fertilizers still very high, and that means that future price of food could still be high. So what does it mean for inflation? As you can see here, we have the historic inflation. As you can see, a big contribution for that spike in inflation in blue was the energy prices, a very big rise in the energy contribution to inflation, but also significant contribution from food prices. But looking at the future, we are expecting inflation to moderate quite significantly from March next year, and to potentially reach the Bank of England target of 2%. By the middle of 2024, because all that spike in energy will come out of the equation, if you like, the year-on-year comparison. But when you look at the impact that is having on the economy, and particularly on household and on consumer spending, it has got a big impact in the short term. So if you look at the real disposable income, so just taking away inflation and actually looking at how much money people have to spend compared to prior years, you can see it fell in the dark blue quite significantly. So people have less money to spend, but they are spending more. The decline in spend, if you look at the consumption per capita in pink, fell by less than the fall in income. So they are getting that money from somewhere, and also the whole consumption fell by more than GDP so far. So there's still other things going on. One of them is the fact that we have what we call excess saving. We've got more money that people have back from COVID, where they couldn't spend everything that they wanted on travel, etc., that they still have. And that's money that they could potentially use now to smooth the consumption while they have that squeeze on their income. One of the problems is that excess money, if you like, tends to sit with the middle income and higher income household, and the lower income household, if you look at the income deciles that are the lowest ones, are the ones that have less saving, but also the ones that in terms of the proportion of their income, they spend much more on the categories of energy and food, where we've seen that very large increase in prices. So that squeeze on incomes is not equal across the population. It impacts different households differently. And it means that in terms of the hit on consumption, those households that tend to actually spend more per income, if you like, the poor households are hit more and are likely to cut spending more. So that's why we are actually a little bit more pessimistic about the impact on the economy, because we think the hit on consumer spending will be significant. And then the other issue that we have, as you can see here, is interest rates. If you look at the dark blue line, you can see that interest rates have gone up really, really fast and really, really high. That is a big shock for the economy. We've had a decade of very, very low interest rates. People were used to very, very cheap money. And that big increase that we still expect a little bit more, although not as high as my colleague here, we're expecting interest rates to peak at only 4% because we think this is already loads, plenty, to try and put downward pressure on inflation. And also because we think inflation will inevitably go down. There's no need to put so much more pressure on the economy. We're already seeing it going back to target. And in fact, there may be a risk of inflation undershooting below the 2% target if we have interest rates too high. So that is a lot of pain. We have a lot of pain in terms of a high cost of food and energy, and a lot of pain in terms of high cost of money. We have a very sharp increase in mortgage rates, but also in the cost of borrowing for companies in terms of bond yields. And that is going to have an impact on corporates, on businesses, as well as on households, especially through mortgages. Mortgages in the UK at the moment, if you look at the pink bar, are generally fixed. There's a very small proportion of mortgages that is variable, which means that households are not immediately, most households are not immediately impacted by this huge spike in mortgage cost. But then if you look at the duration, we have the majority of households on fixed 2-year or 5-year deal, but they tend to expire and roll over. And therefore, by 2024, about 50% of households with a mortgage will be subject already to this very big rise in interest rates. Okay, so even though we're going to see it a little bit expanded, it's not going to be such a direct hit as for corporate lending. It is still very significant, and it is a very big increase in mortgage costs for a lot of households. So going now to companies, we're already seeing more stress there. We've got rising interest rates impacting especially smaller companies at the moment. When it comes to insolvencies, we've seen quite a significant spike in insolvencies already. And we do have companies across different sectors, especially hospitality, that is already impacted by problems with labor supply, for example, but also manufacturing, that are very heavy users of energy, saying that higher energy costs are a real problem for their businesses, which means that all of this is going to make it much harder for them to produce, and potentially would mean that they may need to pass on costs to their end users. The other problems that we have, this is not the end of it, is that we have very weak export. This is very likely to be Brexit related, because we have seen as you can see here, a much stronger pickup in global trade outside the UK. So the blue is global, pink is UK, since Brexit and since the pandemic, essentially. That is likely to be Brexit. It's unlikely to go away. So we have more headwinds for the UK in particular, with this more difficult to trade with our main trading partners, i.e. the EU, and a lot of additional red tape that is making it harder for us to sell overseas. Also, supply chains are still an issue. Generally, if you look at the overall index of supply chain constraint, it has become much lower, but still not back to pre-COVID levels. And we are now approaching winter months. We are in winter months where COVID cases are likely to go up, and that is likely to show in an increase in supply chain pressures to some degree. So overall, what it means, when we look at purchasing managers surveys, which is a really good indicator for you to look at, both services and manufacturing are below 50, showing a contraction. So it's not just us thinking the economy is contracting. There's others thinking the same. And this is definitely, we are definitely entering a period of a weaker momentum in the UK. One part that I haven't mentioned so far, which is very, very interesting, is the labor market. And it is very crucial to determine how severe that slowdown is going to be. So we've already discussed a little bit of the labor market. So I've got different pictures for you here. If you look at the labor supply compared to the labor demand in the UK, you can see that labor demand in pink picked up really strongly as we opened up from COVID, whereas labor supply has remained very weak. So that's why we have a very tight labor market. We haven't got the people we had previously back in the labor force. Why it is a conundrum, we're not quite sure. We have got a few signs of some people that left now coming back. Part of the cohort that we're particularly concerned about is the over 50s that decided to retire early. It is possible that now with a squeeze on income, they've decided to come back, or with the loss in saving with the falls in equity markets, etc., and house prices, they decided to come back. So we may see some more of them coming back. Some of it may be also health related. So we are generally expecting the labor market tightness to ease. As you can see, a different way of looking at it in terms of vacancies. Vacancy rates are going down, as well as the demand for labor is going down, but they're both remaining relatively high in terms of, if you look at it in terms of the historic context, meaning that we're still in a tight market. But overall, this is our focus for unemployment. And as you can see here, we're expecting it to peak just under 6%, which is very similar to the peak during COVID, where we had the furlough scheme to protect us, and nothing like the peak during the Great Recession of the 2008-2009. So we are still expecting a very tight labor market, despite the fact that we are predicting a recession in the UK. And then just generally where we see the UK economy and where the drivers are, as you can see here, we are expecting 6 quarters of a contraction. The first one was in Q3. That was not a forecast. We already know it. And we're expecting all the quarters until 2024 to be a contraction driven primarily by very weak consumer spending, which is a dark blue square that you have there. These are numbers in terms of annual numbers. They're not the numbers that you need to predict, but to just give you a little bit of a context of where we see the economy. We're expecting a contraction of 1.3%, which is much more than my colleague here is predicting. But still, when you put it in historical context, this is a very mild recession. So it would be from the top to the bottom, it would represent a contraction of just less short of 2%, which is less than prior recessions that we had. So it's relatively mild. And then these are the numbers that I have when you translate them into what you need to fill in on your form. My black swan event is not very original, just because, you know, black swans are black swans, and I have no pretension to be able to forecast any of them. I'd say one thing that could happen that is potentially worrying is that we could have a return of a new winter of discontent, which essentially means that we have many more strikes that we have at the moment that expand much further than the unionized workers that we have at the moment, and spread across other countries, so not just being particularly strong here in the UK at this point. That would mean a much weaker economic outlook generally, but also further strain on things like supply chain. So more pain on the supply side, not just on the demand side. And let me stop here a minute early. Thank you.
Right, thank you very much. So my name is Ernest McVie. I spend most of my time actually thinking about the global economy. So that's going to be my first caveat to the forecast, that actually it's really the result of my excellent colleagues, Andrew Goodwin and Edward Appleby. And any mistakes that are in there are really as a result of my very unhelpful comments most of the time. I think probably start in a slightly different place. I actually, relative to my two colleagues here, I'm very much in the middle. I'm not sure whether it's a good thing or a bad thing, but here goes. And I'll talk you through a little bit of the context, all the thinking that we've done. And I think context is important here. One of the things that we think about a lot, and one of the ways we approach thinking about the UK and any other open economy, is really to think about the global economy first. And I'm not just starting here because this is my day job, so to speak. But I think the context to the UK economy as a small open economy, or getting smaller open economy, is really quite terrible at the moment. You know, if you look at kind of global GDP on a Q-on-Q basis, we were seeing about a 1% expansion in Q3, and you think, well, that looks pretty healthy. That's not too bad, well above the level of population growth at global level. But of course, that was largely due to the reopening bounce that we saw in China, sadly now diminishing very quickly. And indeed, you know, our global context to the UK forecast is one in which we're expecting the global economy to enter recession, defined as per capita GDP growth contracting. And as you can see from the red bars, that is largely due to falling output in advanced economies. The US going into recession, Canada going into recession, European Union as a whole going into recession. And that's particularly pertinent for the UK economy, which of course trades a lot with advanced economies, has a large share. And here I just show you the UK world export market. So what are the imports in all those countries that we deal with, that we trade with? What are they doing? And as you can see, going into next year, the first bar after the forecast line, you can barely see it because it's so small. We're seeing barely any growth in those. And if you look back, that's a pretty bad sign, because you don't tend to see that other than in periods in which the UK was in recession. So it's a very, very tough global environment. As Yale rightly said, we made it more difficult to trade with our trading partners through Brexit, but it's also a fact that they're all going to struggle next year, we think, largely as a result of supply chain issues, energy prices, and the impact of this big global synchronized monetary policy tightening that we're undertaking. And of course, that happens at the same point in which the UK economy is already struggling, as has already been pointed out. We're already seeing negative growth. And if you look at things like the PMIs, other activity indicators are available, then, you know, it points to continuing contraction going forward. We did have a positive month in the data earlier on in the week, but I think, you know, you've got to look a bit through some of the distortions from working day and bank holiday adjustments. Fiscal policy, this is where it gets interesting. So I've put up here these measures up to and including the spring statement 2022 here. So, you know, we were looking at some looser policy in the fiscal year we're in and the one next year, and then some mildly tighter, but broadly pretty plain vanilla stuff in terms of the impact of fiscal policy on the economy. Then we did some energy support, and that made things a lot looser. Fine, okay. And then we had some trust tax cuts. They didn't last too long. Then we added on the tax cut reversal, and all of a sudden we're looking at very loose policy in the near term and a bit tighter policy next door. Bear with me, it's been a rocky ride for fiscal policy. Then we added on some energy support being reduced. Fine. And then we had cut some spending and put up some taxes and cut even more capital spending, because that's what you do when you've got weak potential growth. And so basically where we end up is some much looser policy next year relative to where we were earlier on in the year. And then we've got some austerity to come and look forward to in the outer years. Where does that leave us in terms of overall fiscal policy? It's a tricky question, but I tend to like to look at the fiscal impulse. So this is basically, okay, let's take out the economic cycle, the ups and downs, the unemployment benefits, and those sorts of things of the fiscal finances. And then strip all that out and say, okay, what is the government deliberately doing, and how's that going to impact on growth? And you see that in the fiscal year we're in now, and that will end at the end of March, things are relatively loose, but then it gets tighter for the second half of the year. We could argue about these numbers. Clearly, there's going to be more announcements coming up, but I think it's fair to say I would argue fiscal policy is going to be broadly neutral. The government's not really going to do much for the economy over the next year, and I think that's important. Where might inflation go? And I think this is kind of a big driver of not only growth, but also our forecasts in the near term. We have the peak of CPI inflation. We're basically just past it. It'll bobble around a bit at this level just above 10%, and then start to come down once we get past the peak in food prices, which we don't think we're yet at for a few months. Energy prices should start to come down, as should petrol prices, although frankly I think the gap between what we're charged at the pump and what's actually happening to global oil prices is still a bit of a mystery. Frankly, that puts consumers in a pretty bad position, as we've already talked about. Real wages are going to be very negative if you just compare CPI inflation versus average weekly earnings. This is total average weekly earnings, not the excluding bonuses that we were asked to focus on. And I think that's a big problem, as has already been pointed out for consumers. So similar to Yale, I'll just put it on a different chart here, but basically shows you what do we think is going to happen to consumer spending. That's the line, and the bars are the contributions to that. So going into next year, inflation is going to take away a lot of purchasing power from consumers. Fair enough. Incomes will remain pretty steady, continue to grow, combination of high wage growth, but employment growth moderating, and they're going to dip into their savings to help that out. We do have excess savings, I agree with that. I don't think they're going to be able to continue to dip into that for very long throughout the year. So we have a pretty mild outlook for consumer spending, with basically a consumer recession from here on throughout the rest of next year. And given that that's 70% of the economy, give or take, that pretty much puts us into recession. And the fall in output that we expect, we've got about -0.9 for the whole of next year, so a bit better than Yale's -1.2, I think, but a bit better than Steve, a bit worse than Stephen's number. We think that will put us unemployment rate about a percentage point higher than we are today. So that'll obviously, we'll have to burn through some vacancies first, but then once we've done that, that'll start to mean some actual job losses going forward. Big question is therefore what the Bank of England will do in this environment, and we think that they will continue to raise rates over the next few months, 50 basis points this week, and then a further 25 basis point rises. And that will get us to about 4%, and it will stay there throughout next year. key question I think some people will ask is, why are they continuing to raise rates when we're obviously forecasting a recession? Well, I think, any central banker at the moment believes that the long-term impact of higher inflation in terms of lost output is going to be a lot higher than any recession they can cause in the near term. That's one point of view. We think that, as you get into next year and the recession really starts to bite, that they'll have to dial that back down, combined with the fact that, we'll start to see signs that inflation really is starting to fall back, then that'll be enough to make them stop, if not keep rates very high. And it should be, we think that the neutral rate, so the rate of interest at which the economy is neither contracting nor expanding, not putting pressure either side, is around probably just below 2%. So this is still pretty tight policy, even if it doesn't go as high as Stephen's forecast. This is a deliberately obtuse chart, I think. House prices are overvalued by 30% based on mortgage affordability. So if you took mortgage rates today and you said, okay, there's a normal level for mortgage payments as a proportion of income, how much does the rise in mortgage rates mean house prices are overvalued or above that level? And that level's about 30%. I don't really think that house prices are 30% overvalued. If you do it relative to incomes or rents, that's more like between 5 and 20%. 15% I think is probably a good guess. But I think it shows you the impact of the big tightening that we've already seen. And I think the key point to make is, monetary policy takes a while to have an impact, and we've not seen the worst of that impact yet, and that's why we continue to expect further contractions in GDP over the next few quarters. Yale's already covered this much more eloquently than I will, but to that extent, we're going to see there are a lot of fixed rate mortgages out there in the market. So it's only really when people are going to refinance and roll over that debt that you'll start to see that impact. Here, the grey area just shows you the impact on personal sector debt interest payments. So how much people are actually putting out in terms of their income. And you can see that it's going to rise quite substantially, nowhere near to the levels that we had in 2009, clearly, but still a very painful rise from here on in. So that's our baseline. There's some key scenarios around that, and I put these in more to think about some uncertainties. I'll come on to my black swan event in a minute. But I think, the range of uncertainty, it's always high. Economists love to say it's high. And that I do feel it is actually high at the moment, though. We in particular looking at 4 scenarios just at the moment. Starting with a kind of a good one or an optimistic one. What if supply chains do normalize quickly and the commodity prices fall more quickly? That would bring down inflation and allow monetary policy to be much looser. That would be an upside for the economy. But our thinking is much more to the downside, and I've got 3 downside scenarios here. Specifically, what if we did see what if this pickup in inflation isn't actually transitory? What if it is actually part of the foothills of a new high inflation regime where inflation is now just 4 to 5%? That would have a big impact on financial markets and through wealth effects, the economy. Secondly, gas rationing. I think we're pretty confident that economies like Italy now will avoid any rationing, but that is a much worse economic scenario if we end up having to impose arbitrary rules to bring down our consumption of gas. I think supply chain impacts would be important then. And then we're always going to keep a look at the housing market, given the rise in interest rates, and given the understanding really of how might that impact on consumer spending and the UK economy. That's something that's really crucial to our thinking. That's pretty much the bottom of this band here. My black swan event, like many economists, I lack a lot of imagination, so this is not the most original, I don't think. But when I look at parts of the UK economy and I think of what's going on at the moment, we've basically got this huge rise in interest rates. And I think about the really interest rate sensitive parts of the UK economy. And I think immediately about real estate, and in particular commercial real estate. So we've talked about housing, but commercial real estate is really the kind of dynamite the parts of the UK financial sector is built on. If you look at this chart here, oh no, I don't want to do that. That's the one. You can see that globally, interest coverage, so the amount of coverage of your interest rate payments you can make from rents and so on, is very, very low globally, but also very, very low, particularly in parts of the UK residential market. And that's a problem. I don't think it's a problem for the banks, actually, because they're pretty well capitalized and lending standards are pretty good in all fairness. Where I do think it's probably a problem is in private equity and the sort of non-bank financial sector. We know that leverage and the credit standards here shown here are much worse in those parts of finance than they are in sort of public finance. We also don't know what assets they hold. So my black swan event is basically the interest rate impact forces very difficult refinancing of these loans, and ultimately they're forced to sell lots of assets. And I'm just going to leave up my predictions here. I went for 108. That provoked a very long discussion about the nature of volatility, but how I got to 108 for the exchange rate was basically saying what's implied volatility over the next year and how does that relate to our baseline, and I got to 108. There you go.
Thank you very much. 3 great presentations. I'm just going to put up or somebody, there's some magic going on that will show the composite of all 3 of their forecasts as we move into the Q&A. I thought all 3 of those were absolutely really interesting and thought-provoking, really well presented. So thank you. So we've got 10-15 minutes for questions. So if you would like to ask a question, just raise your hand and say who you are and who you like to answer your question. I was just thinking, and as you were saying that economists are not that creative, one of my favorite journal articles was in a journal called it's in the Feminist Economics Journal, and the title of the article is "When Gender is Not a Dummy Variable." You get it? In a regression, you have a dummy variable. Okay, for those of you who haven't caught the joy of econometrics yet, just wait for dummy variables. Okay, so if you like to ask a question, yep, we'll come here first. If you could just tell us who you are, who you'd like to answer it.
My name is Don McCubbin, and it's a question for Stephen, really. The Bank of England inflation target is currently 2%. Would it be preferable if it was used to say 3% or even 4%? No.
There's actually you can hear. There's a microphone there, but I think you can hear anyways.
No, because the whole point of having the target was to avoid any sense that you could manipulate the target for particular political reasons at any point. And it was precisely to stop the kind of political business cycles where politicians would encourage a boom just ahead of an election and be voting back in, and then of course they'd have plenty of time to see the recession through and encourage the boom ahead of the next. And the whole point of setting up an inflation target was precisely to avoid that, was to say, look, we're thinking through election cycles. This is what we're going to keep inflation at. It's going to be low, it's going to be stable, we're going to hold it at 2, and we're not going to manipulate the target just because it's expedient at a particular time. So I think it would be a very bad thing to raise the target, because it would create a precedent that would then have people sort of thinking, okay, we're just going to go back to that political business cycle later.
Thank you. Yeah, that's a theory that political business cycles, if you track countries based on fiscal expansion, you're going to notice leading up to an election, fiscal policy is normally quite loose. So I think monetary policy is trying to avoid that with a clear target. Great. I'll come here, and then if any student wants to ask a question, no question is too stupid. I came in third, and I'm standing up here.
Andrew Conway, economics teacher. Great range of topics. No mention of private sector investment, which used to be something we spoke about. We did hear about the savings bill times as well. Wondered whether it's a factor that you've got hidden away somewhere that you're thinking about, and where is it, where is it going? Last person mentioned, of course, was this trust, which didn't come out from nowhere, and there'd be loads of it. So I thought I'd get your opinion.
Yeah, I know Yale's looked at it. Yeah.
Yeah, I mentioned, I touched a little bit because I only had 15 minutes. So I touched a little bit about companies in the business sector and the fact that we're likely to see it suffering from higher interest rate. And as a result of it, we're also expecting business investment to contract, which is a big problem for us because that's the key driver of productivity that we need to sort out here in the UK. There's a bit of an added complication that we have the super deduction that ends, and we expect some distortion on the back of it. So if you looked at the chart, you'll see there was a point where we were expecting a big jump in business investment and then a big contraction, and that's super deduction. But other than that, we're expecting very weak and lower business investment.
I am looking around, hopefully, to any students who may want to. Yeah, okay, you and then you. Yeah.
So question for Stephen.
Yeah. This is what happens, Steve, when you're the optimistic economist. You just stand out here.
I'm seeing that Q1, you're saying GDP is not going to change. Q1 is going to go down, and Q2 is going to go up. What makes you believe that it's going to go up in Q2?
It's basically the main thing is fiscal listening. So a big part of the announcements was raising of benefits and pensions, etc., in line with inflation. That will kick in April. At the same time, the energy price guarantee, the energy price cap will rise, but the guarantee will remain in place. And that sort of created a bit of goodwill, if you like, that meant our forecast for that court, again, kicking in April, was higher than it would have been otherwise. Yeah, that's the main thing. It's the fiscal thing.
And you had a question, yeah?
My name is Mohammed. I've got a question about the labour market. How come the labour market is tight? What's the main reason as to why the labour market is tight? And how does the government go about investing?
Yeah, good question. And why don't I give it to you? Because it's not just a UK problem, but the UK does seem to have a problem with inactivity.
Definitely. No, it's a great question. Well, I think you do have to look at it both from a demand and a supply aspect. We've clearly lost a lot of people from the labour market. If you went back to pre-COVID and in that decade before, we actually had a lot of older workers remaining in the labour market. So they stayed in, they maybe took part-time jobs rather than retiring, and that actually kept a bit of a lid on wages as well, because they're kind of not necessarily in it for the money, but they're not worried too much about getting big wage rises each month, and so that's fine. Kept a lid on wage growth. And then you come back to post-COVID period, and a lot of those people have left. There's also, we think, a lot of people who are out long-term sick following the pandemic. It's not necessarily long COVID, but it's sort of chronic diseases which haven't been treated, and that may be because the NHS is under a lot of pressure. Frankly, there's also a bit which we just don't know about, and it's a bit of a mystery, but we're lost. If you look at relative to the pre-COVID trend in the UK, we've lost about 1 million people out of the labour market, which is an awful lot out of 32, 33 million. So the supply's gone down. I think there was also a lot of firms who have been busy reopening, seeing very strong demand come back, and they've hired a lot of workers in order to cope with that demand, or at least demanding. I think when we look at the vacancies, I do worry about the vacancy data, because I think about my own company, and if we if we want a new economist, we'll probably put it on about 3 or 4 websites. So I do wonder if there's a bit of double counting going on there, but no doubt there is definitely strong demand for labour as well as very weak supply.
Your question there, and then I'll come here.
I just wanted to ask a question about the general thought process that you have to go through when having to come up with these economic forecasts.
Yeah, great question. I'm not going to ask Stephen or Ines because both of you claim your colleagues did it. So this is
Actually, I must say that it's also, I did it in partnership with my colleague. It wasn't just me. Yeah, I've got to say that. Yeah, it's very important. We're a team at KPMG, a very small team, but we do it together. So, so I think it's really, you just really need to think about everything, but try and keep it simple would be my advice. So just try and think what drives what. It's all about a bit about logic. So for example, you have consumers worry about their job, how much they get paid and how much things cost them. So they're affected by inflation, by interest rates. And if anything move, you need to think, well, how does it move their consumption? So you just think about consumption, investment, a bit of export, imports, government, but mainly consumption is a big bit for the short term. At least investment is important, but also more important for the longer term when it comes to longer term growth. So if you can get consumption right, you're a long way in terms of understanding where the UK economy is going to go.
So this is your Keynesian cross aggregate demand function, C plus I plus G plus X minus M. And then C is about what's, 2/3 of the economy. So good tips. There's a question there. You had your hand up.
Yes. Building on the previous question as well, in terms of measuring on the tightness of the market, how much of that is also taking into account of the quality of the job? I mean, in America, a lot of that is, I'm assuming, short-term holiday, a lot of holiday, short-term squeeze in terms of being the labor for a lot of the supply chain issues or the service industry stuff. So I'm just wondering how that measurement would be calculated in terms of the quality of the jobs.
Ines?
Yeah, I think you're absolutely right. And sorry, I want to add something to the previous question as well. So I'm going to be, now I've got the stage, I can't stop me. The other thing I think it's
A
important
tip not to learn.
I think an important tip for forecasting is always to not just think about yourself and how you perceive things, but remember that the economy is made up of lots of different individuals. And that's important to this question, actually, because I think if you take labour markets generally, what you see is there's a big squeeze on sort of lower skilled jobs, and you can tell that because the price mechanism is telling you that, because that's where the wages are increasing really quickly. So you look at the US, and although they've got high inflation, people at the bottom end of the skills spectrum actually see real wage gains at the moment because wages are rising that quickly. And I think, part of that is because we've got some sectors reopening. People have left those types of occupations and tried to get other ones. If you think about the hotels industry and accommodation and food and restaurants, they're still about 20% below. We've got back about 80% of the dip from COVID, and we need about another 20%. So there's still a lot of demand from just that reopening going on there. And yet on the other end of the spectrum, the tech giants are letting people go because they've hoarded too much. So you're right, you need to think about not just it as a labour market, but it's a market which is made up of very different segments.
Yeah, I think probably close to the final question here, but go ahead. Yeah.
My question,
Yeah.
You said the vacancy to unemployment ratio is 1:1. I see that you put 4.4 as the third quarter unemployment rate. Do you see, are there any policies you may introduce to help counteract the 1:1 ratio?
Yeah, I mean, so two things here. So the first is that the reason I think unemployment is going to rise a little bit next year is because output is falling now. So there's always a lag between falls in output rises and unemployment. And it has put it beautifully in that there are a whole bunch of vacancies to burn through first, and then you'll start, and then you'll see people getting getting laid off. In terms of policies to put in place, I think, again, Ines made the point that the real issue at the minute is that we seem to have lost a lot of people from the labor force, particularly in that 50 to 64-year age range. And that suggests that the policy you want to do is seek out the people in that age range who've left the labor force and help them back into the labor force. Find out why, find out what you can do to make it easier for these people to come back into the labor force. We used to have employment centers that were very good at doing that. They seem to have now moved away from helping people back into the labor force to just sort of finding jobs, if you like, for people who just come in and ask for them. So it's that sort of more active labor market policy is the answer.
I'm going to do something quite unusual at the end. I'm going to try and see if you could briefly tell us your Black Swan event. I'm going to ask the audience to vote. What do they think is the most likely known unknown? I'm just curious, and that'll wrap us up. So, Yael, just remind us of your Black Swan event.
Mine was the winter of discontent, major strikes across the world.
Okay. Ines, tell us about shadow banking briefly.
Yeah, private equity take big losses on commercial real estate and have to sell lots of other assets, and that has a big impact on the overall economy.
Stephen?
I'll go with a positive one, that suddenly the Ukraine-Russia war ends with Russia out of Ukraine, Ukraine back and rebuilding.
Okay. All right. So let's take a vote. Who thinks that Yale's is the most likely Black Swan event? Okay, that's quite a wow. Winter of discontent. Wow. So really, we're returning to the 1980s, not the 1970s. What about for Ines? How many of you think it's shadow banking? Some of you are voting twice, but it's okay. Okay, and Stephen, the optimistic economist. Not many takers, Stephen, I'm afraid, even though we all hope you're right.
It's a black swan.
Yeah, but this has been absolutely fantastic. Thank you all very much for your great questions, for your voting. Reminds me of that joke in Chicago: vote often, vote early, vote again. But thank you for coming. I hope you found this as stimulating as I have. Certainly learned a lot from this group of Titans. If you join me in giving them a great round of applause, and let's see who wins next year.